Open your retirement account not because anything has happened there yet, but because this is where the story may end up. Most of us bought index funds to avoid choosing individual stocks, which was the sensible thing to do. We bought the whole basket, let the benchmark make the small decisions, and got on with our lives. That arrangement works quietly until a company large enough, expensive enough, and important enough arrives at the door. OpenAI is still private, but in 2026, it has raised $122 billion at an $852 billion valuation. It has opened a path for individual investors through ARK exchange-traded funds, and it is reportedly preparing confidential IPO paperwork. If OpenAI lists near a $1 trillion valuation, the question is not only who wants to buy the stock. The question is who may be required to buy it once the benchmark says yes. Once the benchmark says yes, Sarah Fryer's word starts to matter. Fryer is OpenAI's chief financial officer, and at a Wall Street Journal event in November 2025, she discussed the financing needed for OpenAI's infrastructure build-out. The word that followed her answer was backstop, which is a small word with a large balance sheet behind it. In finance, a backstop is what stands behind a deal if the first plan does not carry the weight. Fryer later clarified that OpenAI was not seeking a government backstop for its infrastructure commitments. Sam Altman also said OpenAI did not have or want government guarantees for its data centers. David Sachs, the White House AI and crypto czar, said there would be no federal bailout for AI. That closed the public door, which matters because public doors make good television. The quieter question is whether another door is already open. The financing problem did not disappear when the word changed clothes. OpenAI is a real company with real revenue, which is where the story becomes more interesting rather than less. Sacra estimates that OpenAI reached $20 billion of revenue at the end of 2025 and $25 billion of annualized revenue in February 2026. That is enormous for a company that released ChatGPT only a few years ago, and it would end the story in a quieter industry. It does not end this one, because the commitments gathering around OpenAI are much larger than the revenue line. The information reported projections showing OpenAI could lose $14 billion in 2026 and $44 billion from 2023 through 2028. Fortune, citing financial documents and reporting from The Information and The Wall Street Journal, reported that cumulative cash burn could reach $115 billion through 2029. Those numbers do not mean the technology is fake, because the servers, chips, customers, and invoices are all real. They mean the company is trying to cross a very expensive bridge before the cash flow has finished arriving. The bridge is built out of cloud contracts, chip deals, data centers, supplier financing, and investor money. OpenAI has committed to buy $250 billion of Microsoft Azure services. It has reportedly signed a $300 billion cloud and data center capacity agreement with Oracle. It announced a strategic partnership with Nvidia to deploy at least 10 gigawatts of Nvidia systems, with Nvidia intending to invest up to $100 billion as each gigawatt is deployed. It struck an AMD agreement for 6 gigawatts of chips, with warrants that could let OpenAI buy roughly 10% of AMD at 1 cent per share if deployment and share price conditions are met. Amazon, Nvidia, and SoftBank also supplied the bulk of the newest funding round. Add the pieces together, and the structure begins to look less like one company buying equipment from a neutral market. It looks like suppliers, cloud providers, and investors helping finance the demand that justifies their own valuations. The loop begins with Nvidia because the chip supplier sits at the center of the infrastructure bill. On September 22, 2025, OpenAI and Nvidia announced a letter of intent for at least 10 gigawatts of Nvidia systems. To support the partnership, Nvidia said it intended to invest up to $100 billion in OpenAI progressively as each gigawatt is deployed. The press release presents this as infrastructure for the next generation of OpenAI models, which is true as far as the sentence goes. It is also customer financing, which is the same sentence wearing less event lighting. Nvidia invests in OpenAI, OpenAI deploys Nvidia systems, and the investment helps create demand for Nvidia's own product. That does not make the chips imaginary because the chips are the point. It does mean that reported demand is no longer cleanly separate from the supplier financing the demand. Analysts noticed, which is helpful because the rest of us have other hobbies. Stacy Rasgon at Bernstein wrote that the action would fuel circular concerns. Jay Goldberg at Seaport Global called the arrangement bubble-like and compared it to parents helping a child obtain a mortgage. The comparison works because the concern is not whether the house exists. The concern is whether the buyer could afford it without the people selling the house also arranging the financing. CoreWeave gives the loop another route through the same room. CoreWeave rents GPU computing capacity, and it became one of the companies through which AI demand could be converted into Nvidia chip orders. By 2025, CoreWeave had accumulated roughly 250,000 GPUs, and Nvidia was also a CoreWeave shareholder. In September 2025, CoreWeave disclosed an order form with Nvidia worth an initial $6.3 billion. Under the agreement, Nvidia would purchase residual unsold data center capacity through April 2032 if CoreWeave's own customers did not fully use the capacity. If demand is bottomless, the capacity guarantee should not be the most interesting part of the filing. But the filing put the guarantee in writing, and paperwork is sometimes more honest than conference-stage vocabulary. The loop is Nvidia to OpenAI, but it is also Nvidia to CoreWeave, CoreWeave to Nvidia chips, and Nvidia standing behind unused CoreWeave capacity. The supplier helps build the customer, and the customer becomes evidence of the supplier's market. Oracle adds another route because the same dollar has learned to enjoy connecting flights. OpenAI has reportedly agreed to buy $300 billion of Oracle Cloud and data center capacity. To serve that demand, Oracle has been reported as buying $40 billion of Nvidia GB200 chips for a Texas facility tied to the Stargate buildout. OpenAI pays Oracle, Oracle buys Nvidia chips, and Nvidia demand rises again through a different building. The route looks straighter on a slide than it does on a ledger. AMD adds a second chip supplier and an even cleaner piece of financial engineering. In October 2025, AMD and OpenAI announced a 6-gigawatt chip partnership. AMD issued OpenAI warrants for up to 160 million AMD shares at 1 cent per share. Those warrants vest in stages and depend on OpenAI buying AMD chips and AMD's share price reaching certain thresholds. In plain English, AMD gave OpenAI a path to own part of AMD if OpenAI became a large enough AMD customer, and the market rewarded AMD for the deal. The customer receives future ownership in the supplier, while the supplier receives a customer that helps validate the supplier's market. That may be perfectly legal and fully disclosed, but legality does not make the circle less circular. Microsoft is the quieter version of the same problem, because the loop can run through cloud credits as well as chips. For years, the headline number was that Microsoft invested more than $13 billion in OpenAI. A reader might picture cash moving into an OpenAI bank account, because that is usually what the word investment tries to suggest. Reporting from Semaphore and TechCrunch showed that a significant part of Microsoft's support arrived as Azure Cloud Credits or cloud capacity, not ordinary cash. OpenAI spends the credits on Azure, and Microsoft books cloud usage. OpenAI can describe the support as capital, while still needing cash for salaries, rent, legal bills, and everything that cannot be paid with cloud credits. Cloud credits are useful inside the cloud, while the landlord tends to prefer money with fewer login requirements. Microsoft's current arrangement also includes OpenAI buying an additional $250 billion of Azure services. That turns OpenAI's growth story into Microsoft Cloud revenue, and Microsoft Cloud revenue into part of the valuation inside many of the index funds we already own. Again, none of this requires the technology to be fake. The hardware is real, the contracts are real, and the cloud usage is real. The problem is that each real transaction can also help justify the next valuation. The dollar keeps being introduced around the room as if it has just arrived. This is why the old comparison matters, because the late 1990s were not a story about a fake internet. The internet was real, and the infrastructure being built around it was real. Cisco, Nortel, and Lucent were building the routers, switches, fiber, and servers for a genuine technological shift. But some of that demand was supported by vendor financing. Equipment makers lent money to customers, the customers used the money to buy equipment, and the equipment sales showed up as revenue. For a while, the loop looked like growth, until the financing slowed and the customers weakened. The revenue that had looked independent became harder to defend. Nordal went bankrupt, Lucent lost almost all of its market value, and Cisco survived after a stock decline that took years to recover from. The internet still changed the world, while public shareholders still got the bill for mistiming the price. That is the useful distinction for this episode, because reality does not protect a price from bad financing. Real technology can move through fragile financing, and real infrastructure can be overbuilt. Real companies can become terrible purchases when the benchmark admits them after the valuation has already been made somewhere else. The historical warning is not that OpenAI is Yahoo, AOL, Cisco, Nordal, or Lucent. The warning is that public market plumbing can turn a private story into mandatory public demand before the business has proved the price in cash. That brings the episode back to the index, where private timing can become ordinary account exposure. Nasdaq changed its index rules effective May 1, 2026, with two changes that matter for a possible megacap IPO. The new fast entry rule allows a newly public megacap company to become eligible for Nasdaq 100 inclusion after about 15 trading days, with only 5 days of prior market notice. At the same time, Nasdaq removed the minimum 10% public float requirement. That matters because a company can list a small slice of its shares and still become eligible for index inclusion. The first index weight would be adjusted for float, so a tiny float does not magically become a $1 trillion full weight on day one. The caveat matters because the machine does have manners in small print, but float adjustment does not remove the mechanism. If OpenAI listed at a $1 trillion valuation and floated 5% of the company, the public float would be $50 billion. That float alone would be larger than many public companies. If the Nasdaq 100 admitted the stock after the waiting period, funds that track the index would need to respond. They would not be deciding whether OpenAI was cheap, because waiting for a fair price is a different product. They would be replicating the benchmark, which is exactly what investors hired the product to do. The saver would not be choosing OpenAI in the way a venture investor chooses OpenAI. The saver would own the product that owns the benchmark that owns the stock. That is how passive investing is meant to work, and it is also how private timing can become public exposure. This is the backstop that does not need a press conference. No one has to write a bill, call it a bailout, or ask whether ordinary savers want to underwrite the last stage of the financing chain. The benchmark can do the work, the calendar can do the work, and the ETF can do the work. Everyone involved can say accurately that the rules were followed. That is the part worth sitting with, because the cleanest route is often the one with the least visible decision. If OpenAI becomes a wildly profitable company, this mechanism may look clever in hindsight. The supplier financing, cloud credits, warrants, data center contracts, and fast index inclusion may become the bridge that carried a real market into existence. In that version, the public buyer inherits a company that grows into its valuation. There is another version, and finance keeps that version in the same folder under a calmer name. In that version, model improvement slows, inference stays expensive, customer revenue grows more slowly than the infrastructure bill, and the loop needs outside buyers before the cash has caught up. The same diagram can serve both versions, which is why the diagram is not the answer and cash is the answer. Real customer cash from outside the loop, large enough and durable enough to support the commitments, is what separates a bridge from a transfer. Until then, the public market is being prepared as the place where the story can leave the private room. OpenAI began in 2015 as a nonprofit research company with a stated goal of benefiting humanity as a whole, unconstrained by the need to generate financial return. It is now organized through a public benefit corporation structure, has raised one of the largest private funding rounds in Silicon Valley history, and is moving toward the public markets. That may be necessary for the scale of what it wants to build. It also changes who gets invited to carry the risk. Sarah Frier said backstop, then clarified the word, while the White House said no bailout and Altman said no government guarantees. All of those statements can be true, and the exit can still run through the index. If the company grows into the price, the saver owns a piece of the future. If it does not, the people who finance the room may already have found the door. Either way, the paperwork knows where our retirement accounts live.